This is number 3 in a series of representative lectures, representative lessons from the classes in the new nonprofit certificate program. I want to give you a sense today of what you'll learn if you sign up for my class, Nonprofit Financial Management, in the Nonprofit Management and Leadership Certificate Series. This is a snapshot of the type of thing that we'll do in my class, Nonprofit Financial Management, which we typically offer every fall. The balance sheet is a place where, on a financial statement or on IRS Form 990, where you can learn some fundamental information about a nonprofit organization's finances. And today I want to show you just why that is, and how you can use a balance sheet to understand the shape that a nonprofit is in. We're paying attention to the chat box that you see on the right side of the screen. It's on the right side of my screen. If you have a question, then type that in, and we'll try to answer those after I talk about the after I run through just a couple of lessons about the balance sheet. If you have a really urgent question, like I can't hear anything, then please let us know either in the chat box. We'll try to address that right away. I may not stop like I just did a minute or two ago, but Sean and Charlie, who's on the line too, will help you straighten out any technical difficulties that you might have. So what I want to do today, and understand, of course, there's a lot that I'm going to leave out that we'll cover in more detail in my class. I want to talk about a few things just in terms of basic information about nonprofit financial management. I want to show you, first of all, just enough of the fundamentals of nonprofit accounting so that you can understand how nonprofit financial managers keep track of the organization's finance. Second, I want to show you how to create a balance sheet from a record of transactions, individual transactions that an organization carries forward enters into from year to year. And then third, I want to show you how to use a balance sheet, typically from IRS Form 990, which is the required tax form. I'll show you how to use a 990 balance sheet to assess the organization's financial health. So to start with, again, there's a lot of background. There's a lot of background associated with nonprofit accounting. Well, we'll go into as much of this during the course as is absolutely necessary for you to understand this, but I do want to at least give you a broad overview today. Nonprofit accounting follows the generally accepted accounting principles, which are not just generally accepted in the nonprofit sector, but across all sectors, and they guide the creation and the preparation of financial statements for organizations. The Financial Accounting Standards Board, or FASB, F-A-S-B, is the organization that establishes the accounting standards for all non-governmental organizations, including public sector organizations and except for public sector organizations, for-profits and nonprofits. The balance sheet is one of 3 financial statements that most organizations publish when they produce financial information for the public or for internal management. The balance sheet, which has a few other names, is a snapshot of the organization's resources, obligations, and pretty soon we use the technical terms assets and liabilities, and net worth of an organization as of a particular day. Typically that day is the last day of the fiscal year, but you can produce a balance sheet at any time. Organizations also produce activity statements that show how revenues, how they earn revenues and support, and how they spend money on goods and services during the fiscal year. They publish details about that in the activity statement. And they also publish a cash flow statement just to help readers understand how cash enters and exits the organization's financial records. We'll focus on the balance sheet here today, but I'll show you how you'll see in sort of broad strokes how activity statements and cash flow statements are related to the balance sheet. Everything that we're going to see today with regard to the balance sheet is based on what we call the fundamental equation of accounting. That is, an organization's assets, is equal to its liabilities plus its net assets. You can think about this in a couple ways. One is assets or resources that the organization has, but liabilities are the share of the resources that creditors can stake a claim to. They're not totally owned by the organizations. It's net assets that represent the amount of assets that are under the control of the organization. Put it a little bit more simply, assets minus liabilities equals net assets. That is, what the organization owns minus what the organization owes is equal to what the organization's value is, or what the organization is worth. The thing about everything that we're going to see today, individual transactions as well as entries on a balance sheet, is that this fundamental equation of accounting must be satisfied. So here you see an example of the balance sheet. I want to just show this to you because we'll go into detail about how where the numbers come from, what the categories mean, and how it's populated. But what you see here is that you have the two halves of the balance sheet, the one on the left and the one on the right, represent the two terms in the fundamental equation of accounting. Assets on the one hand, liabilities plus net assets on the other. And because the fundamental equation always has to be satisfied, total assets at bottom left is always going to be equal to total liabilities plus total net assets at the bottom right. So let me back up a little bit here. One more thing to note about assets and liabilities is that both groups of entries in the balance sheet are separated into current and long-term subcategories. On the asset side, current assets include all assets, all types of assets, including cash, but including all other types of assets that might be converted to cash or otherwise used up within a given year. Current assets are listed on the balance sheet in declining order of liquidity. That is, in descending order of how cash-like the asset actually is, how easy it is to convert to cash or turn into cash. Cash is always listed first because, of course, it's the most cash-like item on the balance sheet. But marketable securities that can be easily converted into cash is usually second on the list, followed by revenues owed to the organization and support owed to the organization from outside contributors. Accounts receivable and pledges or grants receivable are next in line. Whoops. Also in the list of current assets include inventory, supplies that the organization owns but hasn't used yet, and prepaid expenses, which are assets that have been paid for in advance. Long-term assets, on the other hand, are not going to be used within the upcoming year or converted into cash. Generally, these are divided up into three categories. First is fixed assets, what we call property, plant, and equipment. Property is just land. Plant typically is the building or the premises where the organization is located, and equipment refers to all the stuff that's inside that the organization uses to carry out its mission. Long-term assets can also include stocks and bonds, which have value but are not going to be converted to cash within the next year, as well as intangibles, which can include patents, trademarks, as well as completely intangible commodities like goodwill that the organization can enter in the balance sheet as long as they can attach a monetary value to them. So just like assets can be classified into short-term, current, and long-term categories, liabilities, things that the organization owes or needs to pay, also can be converted into current and long-term categories. Current liabilities are amounts that the organization owes in the coming year, and like current assets, they're listed also in order of declining liquidity. In this case, it's how soon each organization is due, or sorry, each obligation is due. You have wages payable. That's first on the list because organizations need to pay their employees first. Second, they need to pay their bills. Accounts payable comes after wages payable. Third, they need to pay the bank for principal on loans that they've taken out, so notes payable is always third. And then last, the long-term debt needs to be entered under current liabilities, but only the amount that the organization is obligated to pay in the upcoming year, and only the principal too, not the interest. Long-term liabilities include everything else related to the long-term debt that's not going to be paid in the upcoming year, the non-current portion, whether it's a loan, a mortgage, or some other type of bond that the organization needs to pay. If the organization doesn't plan to pay it in the upcoming year, then it's classed under long-term liabilities. Leases too. Pension liabilities for retired employees, as well as other types of liabilities, which are usually spelled out in the notes of a financial statement, are also classified under long-term liabilities. So remember, under the fundamental equation of accounting, total assets minus total liabilities equals net assets. And the term is used, the concept is used under a different name for for-profit organizations. Owner's equity is a common term, but it's different for nonprofit organizations because, of course, you don't have anybody who owns the resources that a nonprofit has on hand. Instead, that's owned by the public. It's placed in a charitable trust, but net assets for nonprofits are the portion of assets that can be claimed by the organization. And net assets can be classified into three categories. There's unrestricted funds that can be spent by the organization, basically, or liquidated without any restrictions by the donors. Temporarily restricted net assets, where the donor has placed some restriction on what the funds can be used for or when they can be used. And then permanently restricted net assets, where there's a permanent restriction placed by the donor on how or when or whether the money can be used. An endowment, which many universities have, is a good example of a permanently restricted net asset. The organization can spend interest earned by the endowment after it's been invested, but they can't spend the principal. So a balance sheet comes from a record that includes information about every financial transaction that an organization chooses to recognize as a financial event. A financial event is a transaction that affects the fundamental accounting equation by changing either assets, liabilities, and or net assets. Every single type of financial event that can be that affects the fundamental equation of accounting is called an account. An account is just a line item on a balance sheet or on a transaction record or on a budget for that matter. In cash, inventory, accounts receivable, accounts payable, notes payable, all these terms that we just talked about are names for accounts. And throughout the year, the organization's financial people just record financial events on a transaction, a list of transactions, and show how the events affect the fundamental equation of accounting. The issue with every financial transaction is whether or not when the organization should recognize the transaction as a financial event. If the transaction affects an asset, then the transaction is recognized when the asset is owned by the organization, when it's entitled to them, when the asset has a monetary value, and when that monetary value is objectively measurable. Some examples of transactions that may or may not count as assets when an organization receives them. If it gets a bill, if it sends a bill to a client for services rendered, then that is money that the organization is owed, so that counts as an asset. An overhead projector is inventory that has value that the organization can claim as an asset. A mailing list may have value. It's kind of maybe hard to put financial value on it that's objectively measurable, But if an organization can do that, then it can recognize it as a financial event when it acquires one. Liability transactions are classified in the same way. You have they're recognized when they're legally owed and when there's an objectively measurable monetary value associated with it. Just like in these examples, we have financial events associated with an organization receiving a bill from a vendor after they purchase supplies. They get the supplies, they receive a bill from the vendor, they need to pay that bill, so a liability is entered, and if it needs to be paid in the current year, then it's entered under a current liability. Wages due to a worker is always listed under current liabilities, of course, because it's probably it's against the law for organizations not to pay their workers on a timely basis. But a $5 million lawsuit filed against an organization is not recognized as a liability transaction unless the organization loses the lawsuit. Just because someone says that it lays a claim to your organization owing $5 million doesn't mean that you actually do owe $5 million. So you're not obligated to record that as a financial event unless something bad happens to you in court. So here are some examples. I want to show you how to build a balance sheet event by event based on a couple of fictitious financial transactions for a fictitious human rights organization. To show you how to enter these records and respect the dictates of the fundamental equation of accounting. Suppose the human rights organization buys some inventory from a supplier for $2,000 on credit. Of course, we're going to take the $2,000 and add that to the inventory column, the inventory account under assets, but we need to do something else to rebalance the fundamental equation of accounting. We need to show the effect of receiving $2,000 of worth of inventory on the organization's liabilities because the organization isn't paying cash to receive the inventory. And since they haven't paid for the inventory, we record $2,000 under assets in the inventory account. We also record $2,000 under liabilities in the accounts payable account. And the $2,000 on either side of the equal sign here balance out, which leaves the fundamental equation of accounting back in balance. Another example. Human rights organizations often receive pledge donations from donors that they expect to cash in later on. Suppose that the organization has $10,000 in donor pledges owed from the previous year, and they actually receive $8,000 of those pledges. Pledges receivable is a category under assets because even though the organization doesn't have the money yet, it expects to receive the pledges. Once it does receive the pledges, then it can take $8,000 off of pledges receivable, convert it into $8,000 in cash. Same type of thing when an organization pays a part of a bill that it owes. They lose $4,000 in cash, so minus $4,000 is entered in under the assets column in the cash account, and minus $4,000 is listed as an entry, as an event in the accounts payable account in the liability section. Just a couple more examples. One is, what if the organization pays $1,000 in prepaid rent for the first month of next year? Prepaid rent is an asset as long as the organization has actually paid the money. That's something of value that the organization owns. If it pays cash for that, then minus $1,000 is listed under cash in the assets column, and plus $1,000 is entered under prepaid rent, also in the assets column. So the fundamental equation is in balance again with this entry. But suppose the organization signs a contract to buy a new photocopy machine that costs $40,000. What does it enter in the transaction record? It doesn't enter anything. The organization doesn't have to, this is not recognized as a financial event yet. The organization hasn't received the photocopy machine, and they haven't paid $40,000 in order to get the photocopy machine at some point. Once either of those things happens, then there is a financial event and the organization's finances are affected. But just signing a contract under what we call the accrual basis of accounting, which is not something I'm going to go into here, but once just signing a contract doesn't result in anything happening that affects the organization's financial fundamental equation. So to create a balance sheet, all we need are the last year's balance sheets, the information from the accounts in last year's balance sheet from the end of the year, and the information from what we call the transactions worksheet. Just the information from each of the organization's financial transactions with the accounts shown in columns, the transactions shown in rows, and the dollar amounts, positive or negative, shown in the cell entries. We'll use spreadsheets when we do this in class, but hopefully you can see in your mind's eye how these look. If not, I'll show you in a minute. To get the balance sheet entries for the current year, the year's end, we just total up the impact of the transactions that are entered in there, add them to the beginning balances for each account, and report the ending balances on the right side of the balance sheet for the current year. So here's our example of the Human Rights Organization's balance sheet for the previous year. You've seen that before. I'm not going to go into that much detail about it. The thing to keep in mind is that the entries from the previous year, from 2017, become the beginning balance for the transaction record for the current year. They're just they're kind of transposed. The assets are on the left-hand side of the balance sheet. They're on the top row. They're on the left part of the top row of the transaction record. In each of the transactions, the financial events that we just talked about that are actually recognized as financial events constitutes a single row in the transaction record that you see here. And to get the year-end total that we use to populate the balance sheet for this current year, we just take, for each account, for instance the cash account, we take the beginning balance of $45,000, we add up all the entries under each of these rows, each of these transactions, to get the ending balance. So the sum total of all this activity is the cash increased from $45,000 at the beginning of the year, the end of last year, to $48,000. Similarly, for all the other entries under the liabilities column, the other entries in the assets column, the other accounts, all the accounts under liabilities, and the net assets column. We take that information from the bottom row of the transaction record and we just substitute it. We use those numbers to populate the current year's values for each account in our balance sheet. Each account under current assets and long-term assets, each account under current liabilities and long-term liabilities, and net assets too. Again, you see that for 2017 as well as 2018, total assets equals total liabilities plus net assets because the fundamental equation of accounting always needs to be in balance. So hopefully that shows you the basics of how a balance sheet works. Next, I want to just show you, I want to mention a couple things about reporting rules that we use for a balance sheet. Mainly, I just want to show these to you to point out a couple of special cases. There are many others, but just a couple, because you'll see these when we take a look at the Form 990 and the balance sheet that's located there. First, receivables, accounts receivables, pledges receivables must always be reported on a net basis, taking away the amount that you don't expect to receive from bad debts. Second, property and equipment. Those are assets that have value, fixed assets, but you need to report those net of depreciation, which is essentially the amount of value associated with property and equipment that you're going to use this year. And finally, liabilities need to be separated into current and long-term portions, non-current portions, and you only need to count the principal on a balance sheet. Netting out bad debts all we need to know about this is that it happens. You know, an organization doesn't necessarily collect the amount of money that it expects to collect from its clients or supporters, or maybe even its the people that it provides services to. When they need to write off some receivables as bad debts, then the balance sheet needs to show receivables net of bad debts, because you can, in good conscience, count money that you don't expect to receive as an asset. So, for instance, the Science Museum expects to receive $5 million in grant pledges from corporations, but they know in real life that they're not going to collect probably 3% of that money. They deduct 3% of the $5 million, that's $150,000, and record $4,850,000 under grants receivable, because that's net of bad debts. Second, property, plant, and equipment need to be recorded on the balance sheet according to their net book value. Property, land, doesn't depreciate, so the value of property is just reported at its initial cost, not its current market value, but the value of land never decreases because of use. With plant and equipment, the value does decrease based on use, and we call that decrease in value depreciation. What we record for plant and equipment on the balance sheet is the net book value, which is the initial cost minus the accumulated depreciation associated with the use of those assets, those fixed assets. Finally, with long-term liabilities, what you record on the balance sheet is the present value of the amount that the organization needs to repay. For mortgages, that means for mortgages and actually other types of long-term loans and leases too, this means the amount of remaining principal that the organization is eventually going to need to pay. So when long-term debt calls for equal payments of principal and interest, like with an annuity when the amount is exactly equal, we need to separate the principal from the interest and only count the principal that the organization needs to pay on the balance sheet. On the activity statement, or on the cash flow statement, you do count the interest that the organization pays, not on the balance sheet though, because only principal should be recorded there. The amount of principal that the organization owes in the next year is a current liability. Everything else that the organization owes is recorded under long-term liabilities. Here's an example. We've got an organization here that has a mortgage of $100,000. They need to pay it off within 5 years, and the annual interest rate is 8%. They need to pay $25,000, a little bit more than $25,000 per year to cover the beginning amount plus 8% interest. How much do they record under current and long-term liabilities for the mortgage at the end of year 3? Well, it's the total amount that they owe at the end of year 3 is $44,663. They need to record $21,472 under current liabilities because that's the amount of principal they need to pay in year 4, and they record the remainder, $23,190, as long-term liabilities on the balance sheet. They usually round those numbers because it's easier to say them on a webinar, the rounded numbers. But seriously, I think accounting allows you to round up at least to the nearest dollar when you're recording entries on a balance sheet. So hopefully that gives you a sense of what the balance sheet looks like for a nonprofit, where it comes from, and what fundamental principles organizations need to follow when they're recording financial information in the transaction record that eventually becomes the balance sheet. Organizations publish their balance sheet information in a few places, in many cases. Many organizations work with auditors to produce audited financial statements, but every nonprofit organization, not every kind of nonprofit organization, every registered nonprofit that's officially recognized as tax exempt by the IRS, except for congregations and a few other strange categories of organizations, needs to file Form 990. in other words, you can get a 990 form for almost every type of organization. The chief value of a 990 form is that they all have to be filled out the same way because that's by IRS regulations. For an audited financial statement, organizations can choose the format and report their numbers in various ways. To some extent, they have some leeway to do that, not with the 990. With the 990s, you can use Parts 8 and 9, which cover expenses and revenues made during the fiscal year, made and received during the fiscal year. And you can produce something like an activity statement that covers money spent and money gained. You get more detail on a 990 than you typically get in an audited statement, audited financial statement, but you get a lot of the same information. Part 7 of the 990 includes compensation information for all the organization's key employees and the next 5 highest paid employees, everybody in the C-suite plus the next 5 highest paid. And that's useful information if you want to know whether or not the organization is violating one of the major laws of nonprofit finance. It is a law that employees of nonprofits can't take away salaries that are too high. That is especially true for the organization's leaders because of what we call the non-distribution constraint, which prohibits exactly that. If you want to understand, though, just in general what an organization's finances look like, you should look at the 990. You should also look at the audited financial statement if you can find them. The big difference between those two types of statements tends to be that 990s are easier to find. You can get them on GuideStar or Charity Navigator. Organizations don't have to publish their audited financial statements unless they want to. They need to make them available when they want to get loans or when they want to reassure people that their finances are in good shape, but they don't need to show them to you. No offense to you. So what we see when we look at the balance sheet for an organization are the same types of, the same categories of information as we see on a balance sheet from the made-up human rights organization that we were looking at earlier. The balance sheet, Part 10, actually is one page long in portrait format. This is the top part of that page. It shows assets, both current and long-term assets. And again, just like on the made-up example, current assets are listed based on order of liquidity from cash and savings accounts at the top down to investments, land property and plant property and equipment in line 10, and even intangible assets. If the organization can figure out how to monetize those to everybody's satisfaction, they can list them on the 990 as assets. And again, you have information on the balance sheet from the beginning of the year and the end of the year, and you can look at the difference between those two values to see just how the organization, what the organization looks like at the end of the year compared to how they looked at the beginning of the year. You can't quite look at this to tell whether or not, to tell how they spent their money, because an activity statement's better for that. But for instance, you can look at cash and say, well, the organization's in slightly better shape this year than they were last year because they have more cash on hand, looking at the difference between columns A and B in line 1. Total assets will tell you kind of a better sum total of information about how well the organization's doing based on this year as opposed to last year. The numbers in line 16, that is. This is the bottom part of the balance sheet of Part 10. And starting with line 17 going through line 26, you have liabilities organized into two categories. At the top, you've got current liabilities, things that the organization needs to pay in the upcoming year, roughly listed in order of most due first to due latest. And finally, you've got long-term liabilities, loans, other accounts, other notes payable, secured and unsecured notes payable. Go into some detail about that, plus other liabilities that are classified as long-term. You can add up liabilities, all these types of liabilities, to get the entries in line 26. And an organization that has a larger value in column B than it does for column A, you can often say that they're in worse financial shape than they were at the beginning of the year. Now, does that always hold true? Well, not necessarily. Actually, organizations can be in better shape because they've made a brand new capital purchase. If you buy a new building that the organization is going to move into, for instance, then you may actually be in better shape than you were at the beginning of the year, even though you have less cash on hand and even though you have a much larger value for the mortgage that you owe on the property. You're better off maybe because you moved into a place that will allow the organization to grow. Maybe the location is better, and maybe, if nothing else, the organization has just done something that it's planned to do for a long, long time. So, okay, so we've taken a look in Part 10 at the assets, the accounts listed under assets, the accounts listed under liabilities, Gesundheit, both current and long-term assets and liabilities. The most valuable and most informative part of a balance sheet for an organization is the entries listed under net assets, lines 27 through 34 in Form 990 here. Depending on whether or not the organization chooses to follow the federally accepted accounting standards developed by FASB, the organization reports net assets in a couple of ways under financial under this last bottom section of Part 10. If they follow the federally accepted standards for nonprofit organizations, SFAS 117 is the standard, is the entry in FASB's Big Book of Standards. If they do follow that, then they report unrestricted, temporarily restricted, and permanently restricted net assets. And those three numbers can give you a really good sense of how much cash how many resources the organization has on hand. Trying to find a way to not say how much cash the organization has on hand, because any one of the assets in each of these three categories can be easy or hard to liquidate, or can be more or less liquid. In other words, unrestricted net assets might be a building where there are no restrictions on whether or not you can sell it, but it's just hard to liquidate. Permanently restricted net assets might be liquid in the sense that the donor can take the money away, but there are permanent restrictions in place that prevent the owner from, or the organization from spending it on mission-related activities. If the organization doesn't follow the FASB standards for accounting, filling out accounting financial statements, then it needs to enter details about its net assets under lines 30 through 34. You can also look at these numbers to see whether or not the organization's in better shape this year than they were at the end of last year. But I think most organizations these days are following the FASB standards, so they enter data into lines 27 through 29 and leave the rest of the bottom part of Part 10 blank. So that's what I wanted to show you today. First, how accounting works, not just in the nonprofit sector, but in the accounting world, period. No matter what, with very few exceptions, if any, assets equals liabilities plus net assets on every published document and every internal document that financial people use when they're keeping track of organizational finances. Pretty often they use transactions worksheets in some format. This is actually where the idea behind spreadsheets originally came from, like with Excel software, to keep track of all the year's financial transactions, or financial events, I should say, because you don't need to record it in the transactions worksheet unless it meets the standards for whether or not you recognize it as a financial event. If you do recognize it, then you enter a number in a certain column corresponding to the account that is affected by the transaction, and you enter it in its own row because you want to make sure there's one row per transaction. The balance sheet is just a document that keeps track of the organization's assets, liabilities, and net assets at a given point in time. You can get the entries in the balance sheet for the end of the current year by taking all the transaction records in the transactions worksheet, adding them up, and showing the subtotals for each of the accounts under assets, liabilities, and net assets. But if you want to understand the organization's financial health, then look at the net assets entries in Part 10 of the balance sheet of Form 990. Or look at the net assets entries in the audited financial statement, if you can find one for an organization. That amounts to profit for a for-profit organization. It's like profit for a nonprofit organization in the sense that a lot of times it represents what the organization has on hand in order to pay bills or to grow or to carry out more mission-related activities. We don't call them profit because that implies that the organization's owners can spend it on whatever it wants to. Nonprofits are constrained in how they can use their net assets. It's got to be for mission-related activities, but the balance sheet shows you what kind of shape the organization is in, and how able it is to do what it needs or wants to do based on the financial resources that it has. So that's where I would end up here. There's plenty more that I could show you, and in the class, of course, we will do this. We'll do a lot of hands-on work, working with transaction records. I'll show you how to use the 990 to calculate financial metrics that you can use to assess the organization's health. But this is what I wanted to show you today with regard to the balance sheet. And but now I think, Sean, you're going to talk some about the certificate program in general, right? Okay. Okay. So the question is, what happens if the organization receives more money than is being spent? Does the extra money become net assets? In a word, yes. That's what happens. That's why net assets. People don't always use the term net assets when they're talking about a nonprofit organization. The term income is used by nonprofit organizations. Revenues and support are more technical terms that organizations use, because those are used to describe the source of the resources that the organization receives. But you can talk about net income for a nonprofit organization, and it means the same thing as net asset. Well, net income is specific to a given year, and if the net income is positive, then that reflects the fact that net assets increased from the beginning of the year to the end of the year. Either way, I mean, the short answer to your question is yes. When the organization takes in more than it spends, then it records the remainder under net assets. We've got a couple questions here. Should I just scroll up and? Okay. How is depreciation of equipment, et cetera, determined? That is there are a few different ways of doing that. We'll go into some detail about those different ways in the class, but I think the question is whether or not you expect depreciation to occur. The main question is whether or not you expect depreciation to occur at a constant rate over time, or whether or not you expect that maybe you're putting more wear and tear on your organization's fixed assets at some point in time as opposed to other points in time. If you make the first assumption, then depreciation just occurs at a constant rate per year. If it's a 10%, if it's a full depreciation over a 10-year period, then the value that you record is decreased by 10% of the original amount every year until it equals 0 at the end of year 10. Again, though, you know that the assumptions depend on the assumptions that you make determine how you record depreciation, and there are standards that FASB publishes that go into detail about this, but there are different ways of calculating depreciation. Okay, let me know if I haven't skipped a question that we got earlier, have I, Sean? Okay, all right. how would I show a gift from a corporation of a cell phone if the organization then has to pay the monthly fee? Well, the gift, if a corporation gives a gift to an organization, then it would record, and it's a cell phone, then the organization would record the value of the cell phone under assets because it's inventory received. I think inventory would probably be the best way to put it, the best account to put it, to record this transaction under the budget, the balance sheets that we've been taking a look at. Presumably you're going to use the cell phone for something business related. If it's a gift to you, then that's a different story, and you're probably going to have to answer some tough questions about why the corporation gave you the cell phone and what it has to do with your organization's finances. But if a corporation gives a cell phone to your organization and you have to pay a monthly fee for data or buying the phone or something like that, then that's an entry under accounts payable. If there's a current obligation that you know you're going to have to pay within the current year, you record that there. If there's a long-term lease associated with payment in full, then you record that under long-term liabilities. Oops. Okay, I think I saw this before too. What is the amount by law of how much nonprofit employees can be paid? There is no law that says that nonprofit employees cannot be paid more than a certain amount in terms of dollars. What there is are guidelines that talk about how much an organization's leaders or how much an organization's operational directors should be receiving in compensation based on the size of the organization. I think the regulations that the FASB publishes, or actually that IRS publishes, talk about the amount of money that nonprofit organizations, organizations of a certain size are able to pay their employees, their leaders. What the guidelines spell out is how top-heavy the pay structure is. In other words, you can pay employee wages can be 100% of the organization's expenses. That would be maybe not. It might be hard to explain exactly how all that money was mission related, but if you create a good enough explanation, there's nothing against the law per se of paying all of your organization's expenses to your current employees. The question is whether or not the wage scale is top heavy. You don't want kind of a lopsided share of the organization's expenses or organization's assets, period, to be under the control of the organization's leaders. Because if you do that, then it's probably true that the organization is violating the non-distribution constraint, and the leaders are getting rich off of funds that were meant to be given to charity. Oops. Okay, I see a clarification for the question about the cell phone. Corporation is paying the monthly fee. Corporation is giving the phone to the nonprofit. Okay, so the corporation is giving the phone to the nonprofit organization. The corporation is paying the monthly fee. That's a really good question. I think that the issue would be how does the organization record the payment of the monthly fee? I'm not sure. I'm not sure whether or not that would go under inventory. It wouldn't be under accounts payable necessarily because the organization is never obligated to pay the monthly fee. I think the issue, from a financial standpoint, the idea might be that the corporation giving the gift might be paying the monthly fee for the user, and it doesn't represent a financial transaction for the user at all, the nonprofit organization, that is. It's worth looking up, though. In all these cases, I think it's always worth double checking, and we'll do that when we need to. One more question? Okay. This is a question about the value of non-cash assets donated to a nonprofit. Which value is used to determine the asset's value? Is it the appraisal value, or is the price the original owner paid if it is known at the time? Is the value used changed if the nonprofit decides to keep and or sell the asset? Taking the first question first, the value of goods received by nonprofit organizations is the value that was paid by the original owner, because with the value because that's the way that the organization would value assets no matter where they originated from. Second question is, does the value change if the nonprofit decides to keep and or sell the asset? I think the question there is whether or not the organization has used the asset during the time that it was owned. If it does, then I think you need to take depreciation into account, and the current value does change. But I think that is not something that you need that the organization needs to worry about if it's an asset that doesn't really have. If you don't need to take depreciation into account. Yeah. Last, there's a question here. Where would I go to look up how to handle a corporation giving phone and paying monthly fee? Corporation may want acknowledgement to be able to consider a charitable donation. Yeah, that's the type of question where that's why the corporation might care whether or not the organization records the monthly fee as a contribution. If I think with the organization's permission or consent, if they want to consider that a gift in kind, a charitable contribution, then it would record the amount under pledges or under cash if the organization just received the money every month, and then it would keep track of charitable donations by sending the acknowledgement letter to the original donor the same way as they would with any other gift that they received. Okay. Thank you very much for all the questions, everybody. I think just a couple more.
Yeah, well, thank you, Dr. Dietz, for this amazing presentation, and walking through some of these really challenging technical concepts. So we'll ask any additional questions that come in through the comment box. We will send some answers via email, so no worries there. We're just going to take a few minutes now to talk a little bit about the class itself and the graduate certificate program. So I was a student in the financial management class, and I'll tell you that we had the opportunity to learn about all of these different topics and dive in, do some pretty amazing case studies on the course material, and really hands-on experiential components where we consulted nonprofits on their fundraising, their strategic planning, and also looked at their financial statements to see, how do we understand the narrative of this organization through their finances. And this is all part of the graduate certificate program offered at the University of Maryland School of Public Policy and sponsored by the Do-Good Institute. If you do enroll or are interested in this program, you'll be joining an elite network of nonprofit professionals, and you'll be strengthening some skills in management and nonprofits, and gaining a real important credential to advance your career as well. The 4-course certificate is just 4 classes you can complete it in 2 semesters. It's perfect for anyone who wants to advance a career in management and leadership, financial management, strategic planning, and fundraising. And you can take the program either in 1 year full-time, 2 courses per semester, or over 2 years with 1 course per semester. And we're now accepting applications for the fall, and we'll send this information out as well via email for anyone interested. So if you have any questions about the program or have any follow-up questions for Nathan, you can reach out to me to my email or go to this website to learn more about the Nonprofit Graduate Certificate Program. So thank you so much for registering for this webinar, and we look forward to hearing from you in the future, and thank you again, Nathan, for everything.
Thank you, Sean, and thanks everybody who joined us and everybody who's listening in sometime in the future.